Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is August 1st, 2024, and it was quite a day. And we are going to ask the question, or at least ask for the market to please exit to safety in an orderly fashion. It really does feel as though the fire alarm was pulled in the markets, and yet the markets treated it, or investors treated it like a fire drill rather than an all-out fire. The markets didn't panic. The markets didn't go into chaos. We didn't see a massive destructive move. We saw a big sell-off, specifically in technology and the NASDAQ of 3 to 3.5%. And obviously leading that pack, we had Nvidia down 6.9%, Broadcom down 8.5%, AMD down 8%. So a massive exodus from the tech sector. But in the big picture, what really happened, we erased yesterday. So what seemed like it was a massive sell-off, it was a big day, but it was just erasing the Fed day and returning to retest the previous lows, almost perfectly that low close. And so the futures are showing us that we've given back what we got yesterday. That is not panic destructive selling. In fact, we saw rotation into safety. If we were to look at the intraday, the sell-off wasn't so crazy and aggressive. It was steep, but consistent. If we look at the NASDAQ throughout the day, here's the market open, and we sold off, and it was all day until really about the lunchtime when the large institutions theoretically stopped trading actively. It was a steady sell-off. It was liquidation, and it was a flight to safety. If we look at all the sectors, instead of just the technology sector, you can see there's a lot of green in this chart. It's not just all bright red. We have green in Meta and Eli Lilly in the biotech and healthcare sectors. Consumer staples, a safety area. Utilities, a safety area. So our main safety areas, healthcare, consumer staples, and utilities, they all did well. Utilities were up 1.8%, healthcare was up over 1%, and consumer staples were up 1% as well, and a little bit of flight to gold being up about 0.6% on the day. So it was a controlled sell-off. It was a controlled, like the markets lined up and took their turns, leaving the high volatility, high leverage, high speculation stocks like Nvidia, and move to where they knew they could trust, like Procter Gamble. Another way we know that it was not a panic sell, but rather a movement or a flight to safety, is because we saw the US dollar hold. It just kind of held in its position. We didn't see a huge move to cash. We didn't see the dollar get super strong. In fact, here we see it again. There's the market open, 7:30 my time, and initially, there was a spike in the euro, which means dollar weakness, but then from there, we returned, found the market open price, and we just traded back and forth no more than about 5 pips, which 5 pips in the futures market in the euro US dollar is a very flat day. So we were not running away. We were not rushing into cash and getting out of all positions and avoiding everything. We were saying, nope. Where is the safe place to be? It was a rotation into safety. In TheoTrade Live yesterday, Gianni, Brandon, and I, we talked about this idea that after the market reacted to the Fed, we expected a pullback. We didn't necessarily expect it to be nearly a perfect erasure of the previous day, but usually we expect a pullback after the Fed's meeting, and sure enough, we got it. But tomorrow morning in TheoTrade Live, we're going to continue the discussion about how this is playing into the true expectations of a rate cut. We've seen rate cut expectations rise to 3 cuts by the end of the year, and that's certainly putting more pressure onto the market, but the market may be thinking that that also means that we are seeing the signs of economic weakness. Tomorrow morning, as we do the TheoTrade Live, Brandon and I will be talking about non-farm payroll. It is the first week of August. Tomorrow is August 2nd, and we'll have non-farm payroll, and it's expected to not perform that well. Analysts are expecting it to see another 10 to 15% lower than the previous month, and possibly an uptick in the unemployment rate. Average hourly earnings have not risen, and so we continue to see the inflation still where it's at, and whatever slowdown in inflation has had may be attributed to the fact that consumers or the workers are not getting higher pay. And that still has me looking for consumer staples, utilities, and healthcare as the primary place to invest. It doesn't mean that there's not going to be opportunities to take other positions short or bearish, but if you're one that likes to buy and hold positions for a period of time, this could be the sector rotation that could last the next 2 quarters, if not 2 years. Utilities broke through 52-week highs as that flight to safety kicked in today. XLU, being the ETF representing utilities, broke out. And if this is a consolidation pattern or pullback, we have a 67 to a 73 area, roughly about a $6 move would be expected. For 73 would be pushing us up to 79, if not higher. And the trend continues for utilities. We don't have to trade the ETF. You know, some of my favorites, NEE still has some upside pressure, even though it broke through the short-term high. Southern, massive breakout. And as you can see, driven by earnings. I wouldn't be chasing that one, but let it breathe out, let it pull back. Dominion, also breaking out on earnings. And so everything is pointing that the utilities are doing well and outperforming. Some of these you might have to let it pull back a little bit, at least half of the day today on some of these big ones, and let it find that previous support. Duke has done exactly what we thought Duke would do, broke out and reached the 100% target. SRE Sempra. Sempra's broke out through here, and there's still some upside potential for Sempra. Looking for about 83.13. Going over to consumer staples, as consumer staples sets up, we can see we are in this area where there has been pressure to the top side, and we've hit this, let's call it a supply area or resistance area that we've struggled with multiple times. But today saw some significant rallies in underlying stocks within consumer staples. If we look at the big retailer, we'll take Walmart first. Walmart has bounced off of its lows. I like this as a potential to at least retest this previous high, but it really could go back into this trend. Walmart gained from 64 to 71 in a matter of a month and a half, and this could be the bounce to continue that rate of growth for Walmart as a safety play and as a default where people will go shopping. Procter Gamble, I already mentioned, gapped down off of its earnings and recovered more than half of it, which means I still think we're probably going to retest the gap, if not continue to move higher as a break through the highs. PG looks pretty good for upside opportunity. In the same realm, we take something like Colgate-Palmolive. This is not the highest price. You can see the close price back here was 100.88. The high was 101.42. But today we closed at the highest close. So to me, this would be a breakout of this previous high after breaking through this previous high. And there's still upside for Colgate-Palmolive. And I'm looking for a continuation up to 103. Philip Morris and Altria have really not given much of a pullback that we can time our way into this. It's aggressive, it's growing. This is obviously tobacco companies, and the growth that we already saw in that really didn't give anything of a pullback. We had a pullback in Altria on the earnings, gap down, close back up, and that would have been a speculative bounce. I don't see any real opportunity to buy in here. I need it to breathe out a little bit to be able to get back up to that high, but it seems like I'd be chasing it at this point with something like Philip Morris or Altria. And a lot of these stocks in the consumer staples are moving because of earnings. You take a look at Kellogg's, and again, Kellogg's is a huge gap up, close higher, right up to resistance. If you can catch a pullback maybe into the 61 area, not only do I think we can retest the full 62, but we really could go back to the previous annual high. So we've looked at utilities, we've looked at consumer staples. The last one remains is healthcare. Healthcare has had a phenomenal push higher in the biotech. Overall, this is the highest close again. It's not the highest price, but the highest close in the broad healthcare sector. If we look in the subset and we look at some of those biotech stocks like Abbott Labs, Abbott Labs breaking out after pulling back, I've got an upside target of $116. And as we look at this expanding pattern, that is a breakout not on earnings, but afterward. We cleared the high, we broke through resistance, target number 1, 113, target number 2, 116, target number 3, all the way up to 120. And we'd be looking at another 10% increase in Abbott Labs. Additionally, you might look at some other of the labs. Take Core Holdings, huge response to earnings. You can see earnings were a big beat, and the market liked it, pushed up to the high, let it breathe out before stepping back in. Don't chase it too far, but we're seeing massive earnings results out of the consumer staples, out of the healthcare, out of the biotech. AbbVie broke through its 52-week high, not on earnings, but afterward. Also a very positive sign for AbbVie. Amgen closed up here, almost was able to give us the highest close. You can see the close price today was $335.53. This close back here was $335.97. So we had a potential bullish breakout on Amgen, but I would say it's struggling here. Let it breathe out. Maybe even let it get past earnings. Just be aware that we've outperformed in so many areas that wouldn't be surprising to see Amgen outperform as well. Thermo Fisher broke through its 52-week high this last week. And again, not on earnings, but after earnings. And so this breakout for me is telling me that we have a major target on the top side for Thermo Fisher. And we're looking at Thermo Fisher to go to 664 and another probably 8 to 10% move higher. I will have you note as well that we had Danaher on our watch list and talked about the bounce after earnings, the low cost buy opportunity or sell the puts back here. We are up about to the 50% of the expected move off after the break through the 52-week high. I'm still looking for nearly 300 for Danaher. As long as the market continues to sell technology and push this back to its support and possibly through that support at 200 or 210, if we go through 210, I see 190. And it would be interesting if we're looking at consumer staples, say XLP being at 78, or XLV if you really wanted to keep it to the healthcare that has some higher leverage and some higher opportunity. We could make a pairs ratio and a comparison and say, let's take a look at buying healthcare and selling technology. If we wanted to do a ratio between healthcare and technology, we could do a 3 times 2 ratio, 3 times buy the healthcare, 2 times sell technology. And you can see that we created even a price pattern on this. We had a downtrend, lower highs, lower lows, lower highs, lower lows. We broke through that previous trend, started higher highs, higher lows. And at this point, that ratio, $40 for this 3-to-2 ratio is kind of a barrier. If we break through that, I expect us to go from 1040 and go all the way up to 70 and retest this high. That could be an 80% return on investment on that kind of ratio of buying healthcare and selling technology. Now, that being the case, looking for 80%, 100% return on those values, that can apply to individual positions or pairing it as a single position here on the XLV versus XLK. I would say you could get away with it by just simply selling or buying puts on the tech sector or individual stocks inside the tech sector, and then buying the stock or buying calls on healthcare to get the leverage with defined risk trades, but looking for that to nearly double its value over the next 2 weeks to 2 months. Well, that's going to do it for me today. Join me again tomorrow with Brandon as we go through and look at non-farm payroll. Have a great week, and we'll talk to you again next Thursday.